Alright, now everybody's talking about US Fed, and on the other side, you got FI selling, along with what essentially is going to be the outlook from budgets. Crude is also on a rise, so to speak. So for India, it's like a no-win situation. Interest rates are going to go higher, liquidity gets out. Crude is going to suck out and it's going to be making the macros look bad. And on top of that are rich valuations. And typically when you see a combination of a visible fear on liquidity, concern on high valuations, and a spike in crude, all of that has not translated into serious price erosion. And there is no large fear in the market, or I'll not let me use not use the word fear. There is no large visible pocket of extreme attractive valuation in this market, even though the headline news is not something which is very strong and supportive. So Pankaj, that brings me to my obvious question, which is that if I connect the headline dots here, fear of liquidity moving out of India, a genuine fear, it is evident, FIs are selling. Crude at $90, again a genuine macro fear, and then no large comfort on valuation. Can I safely say that based on the headline news and the valuation level, this market should only go down now?
Good morning, Nikunj. See, with Fed coming out with policy statement, what is clear is that the cost of liquidity is going to go up, while the quantum of liquidity is expected to sort of come down. And obviously, that will create the kind of volatility what we have been seeing in the recent past. But having said that, a rising interest rate scenario is good for banks in general. And up till now, whatever numbers we have seen, for some of the key players like, say, for example, Bajaj Finance or Axis Bank, I think retail and rural as a segment are sort of doing well. And near-term profitability for banks is largely driven by the lower credit costs. And our sense is that if inflation is higher, probably that will also translate into some bit of a incremental credit growth. Along with that, if the budget provides the necessary push to the capex, I think credit growth is what will drive the next leg of earnings for banking. Now, with banking being a key component, I don't think that valuations on the banking side is sort of stretched, and which is where we believe that banks overall can sort of cushion the market to some extent, along with some commodities, because our sense is that some of the commodities could remain at elevated levels. Not to mention steel, because as of now, JSW steel numbers are clear that even in Q4, you'll see lower EBITDA per ton. So obviously, there is some sort of a silver lining in terms of banks coming out well. And we have seen not much of a price performance in the bank overall. So I think probably that can sort of cushion the market to some extent. But having said that, with overall broad-based volatility, and I think RBI also will be forced to sort of take rate hikes. So obviously volatility is here to stay, and lastly, I think a lot of new age companies could be a lot more under pressure, along with some of the tech names or the high P multiple. So obviously that is going to be there. But I think banking overall should help cushion the market or cushion the volatility going there.
Suresh, we spoke about a technical rebound, and a sharpish technical rebound is around the corner. As we walk into trade this morning, SGX is down by about 2%. Is your call on a technical rebound still valid, or today's SGX and the global market setup has poured cold water on it?
So the rebound is structural, wherein I would say the volatility, as I said, would continue for the next few days. Also, a retest of the same lows for global markets is a possibility, and I think that is what is going to play out over the next few sessions. So Dow Jones going back to 33,000 levels, Nifty trying to test that 16,800, and even an outside case for 16,400, 500, which was the previous low, would be normal. And that is where is the opportunity to start looking at as a fresh opportunity. What we've seen is a VIX go towards 40 capitulation phase happening across the world. Once this volatility is done, the budget event is also done, we'll again go back into a slow and steady upside, with the difference that COVID beneficiaries would remain under pressure, and sectors and stocks which did underperformance over the last 1.5 years post the COVID crisis should start taking lead going forward. So it's a time to transition from a COVID related world to a post COVID world.
Pankaj Pandey, three stocks here, absolutely clear that your clients, they should be buying them and they should be using the decline to their advantage. You can name two, you can name three, you can also choose to name one. But what are you telling your clients to buy in this decline when everybody is talking about Fed and budget? I'm sure this market shakeout is creating opportunities.
Question is for me.
That's right, Pankaj. I said you can name 3, 2, 1, that whatever you choose, but stock where you think that the risk reward ratio is favorable.
Yes. So I think of the recent numbers which have sort of come out, I think textile as a space is looking a lot more attractive. So we have really liked the results for Gokuldas Exports. Along with that, even Bardhaman Textiles also has come out with pretty good set of numbers. And I think both these companies are looking to sort of capitalize on the China plus one strategy with incremental capex going forward. And we have seen, or we expect both these companies to sort of deliver both top line and bottom line growth in excess of 20% CAGR. I think that is one space. Then I think banking is another space, like I said, is looking attractive, especially given the fact that some of the demand drivers, especially say from real estate, looks to be pretty strong. Along with that, we are seeing a rural sort of pick up in terms of overall numbers. And I think if budget provides the necessary support, banking is another sector which can sort of help the market overall. And I think in this sector rotation, banking will be the biggest beneficiary in terms of overall incremental allocation and could sort of cushion our portfolios in a lot more better way. Then we'll have stock specific calls. Say, for example, the Aztec numbers were quite good. CRAMS as a story we have been liking, and our sense is that we'll see far more better numbers. And so CRAMS is, whether it is on the chemical side or whether it is on the pharma side, I think this is one particular segment where things can become a lot more better. We haven't seen much of a price performance from most of these chemical companies or, for example, pharma companies. So that is another thing. And I think since domestic growth for pharma companies have been good, which is what is coming out clearly from Cipla numbers or Torrent Pharma numbers, I think MNC pharma companies also have seen decent amount of sideways movement. So that is another leg which can sort of do well. So I think there are some pockets which can relatively outperform. And this is what we have been sort of recommending. And on top of it, I think rebound sectors, say for example, Inox, PVR, I think those are also looking good to us.
Right. Okay, although the market of late has been completely ignoring all earnings, good or bad, and it's really been painting all earnings contenders with just one color, and that's red. Maruti, surprisingly, even though the numbers came in around 2 p.m. or so on Tuesday, the stock actually managed to push up quite a few gains. In fact, it was the top winner on the index. Almost a 7% surge is what you saw for Maruti. Will the gain sustain? What are the brokerages saying about the earnings? Let me take it across to Shrishti and find out more.
Well, yes, after a great set of numbers coming in from Maruti Suzuki, we saw the stock rallying as much as 7% in the trade. But post this, it was followed by a very positive commentary by the management, especially on the demand front. They expect further moderation in the raw material inflation, and most importantly, they are working on new model launches. After this, majority of the brokerages have raised their target price. First up, let's tell you what Macquarie has to say. So they have maintained their outperform rating on the stock with a target price of 9,752 rupees apiece. They say that there are multiple earnings lever, and this time it was a solid Q3 earnings beat led by quarter-on-quarter gross and EBITDA margin expansion. And going forward, they are positive on the cyclical demand recovery and margin tailwind, on the back of which they have raised their FY23 earnings estimate. But on the other hand, if we see what CLSA has to say, so they have maintained their negative stance on the stock with a sell rating for a target price way below the current market price, that is at 6,440 rupees apiece. They do mention that this in the results this time it was a positive surprise led by a lower impact from the raw material cost, But they mentioned that the demand remains strong, but the order book is not increasing significantly and the discounts are still quite high despite the pending order book, on the back of which they have maintained their negative stance on the stock. So Macquarie on one side is positive, but CLSA is not finding that great opportunities in Maruti Suzuki.
Okay, Srishti, we'll leave it at that. Let's see whether the gains in Maruti sustain or not. But it's important to highlight what Asia is up to because you're not seeing any recovery whatsoever for the Asia markets. Look at Japan, it's down almost 700 points now, and it's a 2.5% sharp cut that you're seeing across the Asian basket as investors begin to digest the Fed commentary. 6.5% or rather 0.6% lower for Shanghai, 2.5% gone for Hong Kong, and even the periphery markets like Korea, that's taken the sharpest knock. A near 3% cut is what you're seeing for Kospi as well. The pre-markets rates for the US, even though the handover from US equity markets was quite okay last night, but it's near about 400-point fall that you're seeing for the Dow futures, 1.5% lower for S&P, and the Nasdaq futures as well are trailing lower by 1.6%. So seems like it's going to be yet another Monday kind of picture perhaps in store for us, at least going by how the global markets have been panning out. Kunal, last when we spoke, you said that IT was the weakest link, not just domestically, but globally as well. It is the tech stocks which have actually led the fall or perhaps triggered the fall in this case. Are there more baskets or more sectors now joining that pack? Is there anything which is looking weaker than IT?
So interesting, Aisha, because in this last 5 days or 6 days of the market correction, we just look at the kind of stocks and sectors which have made fresh lows for themselves, and I'm trying to compare them with either their December 2021 lows, which was almost like a month and a half or back for these stocks, or even the last 3 month lows for many of these names. For example, IT stocks of course have managed to break past below their December lows for themselves, and then it's surprisingly it's not the banking, it's not the autos which have made fresh lows. In fact, these sectors have actually shown some good, strong relative outperformance and strength as compared to many of the other peers. But the other two sectors, which have shown signs of sharp correction is actually the Nifty Pharma as well as the FMCG index. Now, these three indices, FMCG, Pharma as well as IT, which were termed as the erstwhile defensives, these are the three key sectors which are getting into the sell-on rallies kind of a mode. These are the sectors and stocks which are making fresh lows for themselves on a consistent basis. Add to that, other stocks like the cement space, there has been a sharp selling and a reversal into these stocks. That's been one of the other hallmark of this market correction. Names like Ultratech Cement, Ambuja, ACC, these stocks which are very typically low beta names have fallen by more than 15% to 20% on an average, and that's a very sharp correction given the stature of these kind of stocks. So there are a lot of sectors which are not the usual stocks which have gone into a correction mode, and which is why it becomes very difficult to anticipate that when this volatility would end, because on one hand the banking and the autos and a couple of other smaller sectors, they keep on showing those signs of resilience and momentum for themselves, but on the other hand these erstwhile strongest sectors and stocks, they are the ones which are seeing a lot of damage. So I believe as of now that the pain is still there into many of these IT names. Those stocks and those sectors could probably get into a further correction mode, but then the relative strength and the outperformance still lies with the banking and auto stocks.
Banking from the start of the year has been talked about being the outperformer for 2022. Now, in the run-up to Union Budget on 1st of February and bang in the middle of all the global volatility that we are seeing, the International Monetary Fund has cut India's GDP forecast to 9% versus its own outlook of 9.5%. This as concerns over the new Omicron variant once again led to a shutdown in economic activity in parts. The IMF hopes that 2023 is when we're going to see improvement in credit growth. Here's more from the IMF's Dr. Geeta Gopinath.
If you look at the 21-22 fiscal year, for that we have a slight downgrade of minus 0.5 percentage points, and for the next fiscal year 22-23 we have a slight upgrade of 0.5%. percentage points. So growth for the previous fiscal is now at 9%, and for this year now is at 9%. So we moved it up slightly. The main reason for the downgrade for the 21-22 fiscal, it comes from Omicron, and because in this first quarter of this year, there have been localized lockdowns and restrictions in activity and mobility, and that has an impact on the growth numbers, which is why we have a slight downgrade, and that postponement of the recovery is what's feeding into a slight upgrade for this following year.
Well, that's more from the IMF on its own outlook and forecast for the Indian growth story. Nikunj, I'd like to come back to you and talk in more detail about what we were discussing at the top of the show. Yes, we've seen the kind of commentary, hawkish commentary that is coming from the US Fed chair. We know there will be rate hikes. We will know that there's going to be a winding down of the quantitative easing program. But this is not the same India that we saw in the last taper tantrum.
Nandara, that is the bottom line. We need to understand and we need to look at the setting. The setting, both macro, market valuations, and the trajectory of the earnings, and also domestic institutional investors and what their positioning is. While it's very easy to say that, look, if rates, global rates, they go higher, liquidity will move out, and that's going to be end of the liquidity curve for emerging markets. So let's look at it. First, the scenario. The scenario for on the macro front for India is vastly different than what it was in 2015, both in terms of macro, our forex reserve, the curve of the interest rate, and also our ability to really digest a currency shock because our forex reserves are north of $500 billion. Second, earnings trajectory. Between post 2015, we saw a real crunch down in earnings, and especially for large sectors. Power, banks had to be recapitalized. They had to go through a painful NPA cycle, and there was no large private sector capex, which in a sense was coming out because the economy was in a contraction mode. Third, which I think is the most important point, is the starting point of valuations. When the last rate cycle started, the Nifty valuations were vastly different from what they are. The Nifty valuations were in early teens. Now they are in late teens. Actually, they are above 20% if you look at some estimates. So that is a big difference. While the economy is on a much stronger wicket, the earnings trajectory for next couple of years would be very different from what it was in 2015, where you're contracting versus now you're expanding. The challenge is that your starting point of valuations also is strikingly different. So this in a sense becomes the limiting factor. So for the risk for the market, I guess, is not so much so on the earnings front, it is on the valuation front. At what point in time Indian markets they start becoming attractive again. And if I may just throw one more ingredient in the melting pot, I think the change is domestic institutional investors. The kind of the hurrah with which domestic institutional investors have come back, this is retail money when I say domestic institutional investors, it talks about a serious commitment coming to equity as an asset class by the new millennials, by what essentially is happening in terms of the household savings coming back. So that's also a differentiating factor. Again, you can toss it up and you can put a cherry on the top by using words like startup, how the economy has become much more efficient, how productivity rates have gone higher, and how tech in a sense has become a much more larger contributor to India's GDP and the total earnings picture. So the difference is that banks are at a different cusp of cycle, IT is at a different cusp of cycle. If you take the valuation aspect aside, which is going to be a limiting factor, I think this rate hike cycle is strikingly different.
Alright, to the pre-open rates, 9 a.m. this morning, on the brink of 17,000 actually on the pre-open take. Wonder whether or not we're going to sustain this level throughout the trading day, given what we're seeing across the globe. For now, the Sensex, though, quite a different story, a strong uptick of 200 plus points. But our chartists are standing by, so let's find out what they're identifying by way of mid-cap strategies. And Naresh, run us through your top bet.
So that would be a buy on Bharat Dynamics Limited with a stop loss at 435 and a target price of 550. It's a longer term bet wherein the stock over the last 3-4 sessions has sustained above the breakout point of 450. It's a good cup and handle formation, increasing volumes over the last 3-4 sessions. Back in July, August 2020, the stock had made a similar high of 460, 470. Even in 2018, 450 was a major resistance. So finally, the stock is breaking out of a 2 to 4 year pattern, expecting it to take a much bigger move over a period of time.
All right, that's part of the dynamics. Meantime, Kunal, flag off your top mid-cap recommendation.
So I've gone with a bit of a high risk strategy on the mid cap name. It's a buy on India Mart. Now the stock has gone to a very sharp correction in the last 10 days. It's corrected from 7,000 odd to 5,000 odd levels. But at this 5,000 mark, on the previous trading session, the stock had entered into very sharp degrees of below Bollinger Bands, 3 sigma Bollinger Bands. So it's been trading quite sharply below those levels. And typically when you see the stock prices getting into those extreme zones, there is bound to be a mean reversion into these names in a very short span of time. So I'm expecting some degree of bounce back coming into this name. Buy with a target of 5,250, stop us at 48.50.
Alright, there are your mid-cap recommendations. But getting a move on, let's hear it out then from Kotak AMC's Nilesh Shah. He believes that capital goods and industrials are sectors to bet on and says that the government's infrastructure push is only going to benefit these sectors which are poised for strong growth going ahead.
In the technology sector also, or outsourcing sector per se, including technology, pharma, chemicals, they will continue to grow their business. But there the valuations are expecting a tier away growth. And we believe mid-cap IT companies may not witness a price correction, but certainly they will witness a time correction so that fundamentals can catch up with the valuations. Today, mid-cap IT companies are trading above large-cap IT companies because of the growth expectations. In case those lofty growth expectations are not met, there will be a time correction. The second thing is related to capital goods and industrials. We believe capital goods and industrial sectors, after a hibernation of almost 4 or 5 years, is poised for good days ahead. There are sectors like cement, steel, sugar, where capex cycle has begun. Government's infrastructure spending has increased. The exports opportunities are also coming through. And most importantly, most of these companies in capital goods sector have operating leverage. They have cut costs, become more productive. So we believe there is a slightly birbal ki khichdi type multi-year cycle. It may be slow in the beginning, but will pick up the pace at the later date. And capital goods and industrial companies will have a couple of years of above average growth and margin expansion. Now, as I again say, operative word is birbal ki khichdi. It will start slow and then it will gain momentum. But as a fund house, we have been overweight industrials and capital goods. We are also in the process of launching a manufacturing fund with the hope that this renaissance of manufacturing will be captured in our portfolios.
Okay, it's time for the Mega ET exclusive. But before that, Pankaj Pandey, great to have you on the show. I'm going to let you go on that note. Have a good trading day ahead. Well, the next railway budget, it seems, is going to be based on the theme of reform, as we understand, transform as well as perform. In fact, high-level sources tell ET now that this year's railway budget will set the roadmap for a national transporter for coming 10 years. In fact, Samir Dixit, my colleague, joins in and he tells us that the government is going to be terming it as a turnaround budget for railways with a spend of almost about 10 to 12 lakh crore rupees over the next 10 years. So what's exactly in store? Let me take it across to Samir and find out exactly that.
The upcoming railway budget is termed as turnaround railway budget that will set a long-term vision for Indian railways And by long-term vision, it simply means that where the railways will be heading in next 8 to 10 years. That is the reason that the budgetary outlay of railways could be somewhere around rupees 10 to 12 lakh crore that will be spent in next 8 to 10 years, and so as to transform the Indian railways. Now the theme of upcoming railway budget is going to be reform, perform and transform. It is very likely that India's second bullet train could be announced in upcoming railway budget, and this high-speed train or bullet train could be announced for Delhi-Howrah route via Varanasi. Varanasi is Lok Sabha constituency of Prime Minister Narendra Modi. So a bullet train could be announced. Second is that all the golden quadrilateral routes or especially the metro cities will be connected via Vande Bharat train. So these are train sets popularly known as Vande Bharat trains, and these trains will be running on golden quadrilateral route like Delhi Mumbai, Delhi Chennai, Delhi Kolkata, and with this a semi high speed mobility will be brought in Indian railways. That simply means that these Vande Bharat train with an average speed of 160 kmph will be running on the golden quadrilateral route. Along with this, we can see that aluminium-based train sets could be announced in upcoming railway budget, which is likely to be the future of train sets in India. Third is that in terms of safety, all the old ICF coaches will be removed from railway network, and only LHB coaches or train sets will be allowed to run on the railway tracks, and that is going to be the future of Indian railways when it comes to passenger side. Third important aspect is that the stations. So it is very likely that 50 A1 category railway stations could be taken up, and that will be floated for the station redevelopment project. So these 50 stations will be developed by private players, and this could be taken under the station redevelopment project, and it is very likely that it will be announced in upcoming railway budget. So a lot of emphasis is going to be on the passenger side, improving the overall experience, and these big announcements we can see in the upcoming union budget to be made by FM Nirmala Sitharaman.
Okay, that's what the budget has in store for passengers. But Sameer, tell me, what is going to be the roadmap for railways in terms of earnings, freight and green mobility?
Freight is the biggest earning source for Indian railways. It simply means that we can expect a big announcement related to the transformation of railways freight side. Starting with that, it is very likely that the roadmap for Indian railways, the role of Indian railways in Prime Minister's Gati Shakti Yojana, this roadmap is likely to be announced in upcoming union budget. Another important point is that a target could be announced to bring down the logistic cost from current 14% to 11%. This simply means that in coming years, if you want to transport your commodities, whether it be coal or even car, the logistic cost is likely to be reduced by around 3 to 4%. It is going to be cheaper for any player. So that announcement is likely to be coming in the upcoming union budget. Another important aspect is that you might have heard of EMU passenger trains, but for the first time EMU parcel train could be announced in the budget. So by this EMU parcel train, railways will try to attract big players or new players like the e-commerce player. Another important aspect is that first time timetable based freight trains could be announced. This simply means that you can track your entire shipment by what time it is reaching to the destination, and a timetable based freight trains could be announced in upcoming union budget. Along with this, we can see that the small containers which were discontinued in the railways, now these small containers with an axle load of 2.5. So these are likely to make a comeback in the railway network. By these small containers, railways will try to attract more and more private players or new players, so that they can opt railways as a preferred mode of transportation for their commodities, or whether it be in small quantity or big quantity. So this sort of big announcement we can expect that is likely to be made in upcoming budget, so as to transform railways freight earning.
Reform, transform and perform. That may very well be the theme of the announcements that you're going to see related to the railways and the railway budget allocation with a 10-year roadmap. That's the big ET Now exclusive, which is also broken simultaneously on our sister concern, ET Now Swadesh. Thank you so much, Sameer, for joining us with that exclusive news break. So only 3 days full trading sessions left for union budget. Nikunj, I know all the headlines are of course being dominated by other factors, the US Fed, rising inflation, PE compression, what will happen in the bond markets, crude oil markets. But union budget is traditionally, of course, seen as a big trigger for the equity markets too. But this year seeming very, very different.
Nandana, you have not seen a pre-budget rally. If at all there is a global panic and there is a meltdown in some of the tech stocks, the chances of markets going higher if the budget is reasonable and if the budget is, if the what just Samir spoke about, a focus on railways. Imagine the multiplier this impact. Imagine the multiplier the reboot of the railways will do for the sector, for the country, for the productivity, for the logistics sector, because we know that we may be having the biggest railway network in the world, but unfortunately a railway network is not the most modern railway network in the world. So if this kind of a large expenditure commitment comes to a sector like Indian Railways, it's going to be incrementally changing the fortunes of a lot of sectors directly, indirectly, and also the productivity benefits would kick in. But for the day to day, since we have exactly 2 minutes left, a little over 2 minutes left, I'm going to ask one question each to Kunal and Nuresh. Kunal, what is that turning point on the Nifty at which you would say, I will buy the panic buy? I've got 30 seconds to get that answer from you.
I would probably wait for 17,250. If that level gets, if we bounce back to those levels, that will be a first trigger that we've come out of that selling correction and could be in for a much more stronger rally, like what we saw on previous trading session.
Nuresh, what is that number beyond which you would say, I'll be a buyer?
So that would be 17,300. Once we cross that, a little bit above yesterday's high, would be a panic buyer.
So you've got two minutes left. Now, remember, as you walk into trade this morning, we are staring at three pockets here. One, the near term and the short term momentum, where globally, it is not that the dam is broken. Yes, markets were volatile. It turned after the Fed. It turned after what we heard from the Fed conference. The Fed, in a sense, has now given a clear roadmap. I think the cat is out of the bag. You know what Fed is thinking and what Fed would do. So that suspense and that fear adjustment, I think, is behind us. Whether it is going to be 50 plus 25, whether it's going to be 25 into 3, whether it's going to be 3, not 3 but 4. The Fed has said that interest rate and aggressive interest rate hike is coming. The bond markets have not spooked, but the equity market, in a sense, which were volatile, they've got a reason to turn much more volatile. Then the second worry is the crude. On the macro setup, that definitely will have its underpinnings, but that also means that in the near term, the commodity and the energy complex will outperform. Third is we are in middle of earnings season, and frankly, the earnings are not bad at all, and the outperformance is now getting more and more visible in the way of banks are outperforming because banks are delivering. That's the third pocket. That earning, how bad or how good, I would say the number of estimate beats and the number of estimates which have been met, I think that is not a bad number. The fourth is the budget part, and this is where I think you've not seen a pre-budget rally. If history is a benchmark to go by, if you normally see a 5-6% sell-off and if global markets are stable, then there is a case for markets to rally after the budget. This could be one of those budgets where you're not expecting anything shaky, but you're not expecting anything big. And if there is some substantial focus given to, like Samir said, railways, something on the expenditure side which could re-rate some large sectors which could have multiplier impact, then those related sectors and those stocks, in a sense, will come back. So this budget is unlikely to re-rate IT, startup and all those large technology dominated sectors, but industrial, cyclicals, road, those are the places where you're likely to see some uptick coming in. So I'm just going to move away from the first rates and I'm going to just set up the first rate. It's 1.5% down for the Sensex, 1.5% down for the Nifty, 1.5% down for the Bank Nifty. So this is in line with what the SGX was indicating. Are we in for a panic low today, or the market opening in itself will act as a gap down start, and then we are likely to really the fall may, in a sense, multiply after that. So let's see where that opens. The stocks which you want to address, well, Cipla, United Spirits, Maruti. Why? Because they are newsmakers. So banks are not like off to a very shaky start, so to speak, but individually the breadth is completely dented. It's a dented market breadth, so to speak. So Cipla, The domestic sales are coming back. The COVID halo effect is behind them. Maruti, a great Tuesday. Very little follow-up buying, but it is bouncing back. You want to look at USL, the numbers were decent. They become almost debt-free now. No, that's UPL, USL, United Spirits. United Phosphorus is not what we want to look at. It just load up, just bear with me for a second now. That's United Spirits for you, 860, nothing wrong with the numbers. Let's see if this one really bounces back. Since crude prices are at $90, the only green you can see on the screen, perhaps on the Nifty, I think is ONGC. But I said the breath is bad. We're off to a weak start in line with what Asia is doing. Are we in for a day of recovery, or are we likely to snowball into another weak start? So far, the evidence is that 2-3 minutes into trade, no big follow buying. It's brilliant.
Yeah, 16,962. It's a cut of over 300 points on the index alone. Breath again dismal. It's exactly like a Monday kind of picture, at least to start off day with. Torrent Pharma down 9%, India Mart down 3.5%, and India Mart, remember, has already fallen a whole lot because the Q3 performance fell short of market expectations. Emphasis is down, Apollo Hospitals is down, SRF is down, and TechM as well is down. SRF though reported strong numbers, but you're not seeing that kind of a reaction from the street. Also strong numbers from Maruti, but no follow through, although the stock ran up nearly about 7% on Tuesday alone. You also have Macrotech, Cipla, TeamLease, Federal Bank. They've all reported some decent numbers. So let's see whether or not there is a reaction anywhere there. Weak numbers from United Spirits, weak numbers from Shriram Transport Finance, APL Apollo Tubes, even Torrent Pharma, which of course is the weak link this morning. That said, I just want to check in on what the Nifty IT index is up to, because again, the large caps are the ones which are weighing acutely heavy. Wipro's down 3%, TechM is down 3%, Infosys down over 2%. Even banks for that matter. Look at the kind of movement that you've seen on HDFC Bank of late. Even on Tuesday, when the rest of the market recovered, HDFC Bank was still lagging the rest of the banking majors. HDFC Bank is opened sharply lower, down about 3%. Even ICICI Bank and Kotak down 1.6% apiece. Tata Motors has fallen some more, 1.7% lower. Reliance falls further, it's down 1.5%. And I definitely want to revisit the entire newly listed space. What's happening to Zomato after breaching that 100 rupee per share mark, where the Nykaa has fallen more and where the Paytm has dragged even more. So that is another space that we're keenly observing. But yeah, no spot of green, all sectors in the red, the index down nearly 300 points. Okay, in fact, Aditya Narayan as well is on the show with us. Aditya, hi, good morning. Not really the best of mornings, Aditya, nowadays. Wondering why